Welcome to the deep dive. Today, we're really getting into it, the first quarter financial results for Bank of Maharashtra. This covers up to June 30, 2025.
That's right. And we've got quite a bit to work with: the investor presentation, press release, the full earnings call transcript, board meeting outcomes, the works.
Exactly. So our mission, as always, is to cut through all those numbers and that, banking jargon. We want to give you, the informed learner, a really clear picture of what actually matters.
What surprised people, maybe, and what it all means in the bigger context.
Yeah, hopefully leading to some of those aha moments along the way. So where should we start? Maybe the general economic scene back then?
Good idea. That sets the stage. The bank itself painted a, well, mostly positive picture of India's economy in Q1.
Okay.
They highlighted the projected real GDP growth, 6.5%, for the fiscal year 2025-26. This pretty robust expansion.
Right, solid growth.
And the Reserve Bank of India, the RBI, was active. They'd cut the repo rate cumulatively by 100 basis points over the year, bringing it down to 5.5%.
Okay, so easing rates.
And they also cut the cash reserve ratio, the CRR, down to 3%, effective from September 25. That was aimed at boosting liquidity in the system, more cash available.
So generally supportive moves from the RBI then. What else was looking positive?
Well, a big one was inflation. It dropped quite a bit, down to 2.1% in June 2025.
Wow, 2.1%, that's low.
Yeah, the lowest since January 2019. So that's great for stability. Plus, India's forex reserves were strong, nearly $700 billion, and sort of a major milestone. India officially became the world's fourth largest economy in 2025.
That's huge. Quite the backdrop for the bank. But were there clouds on the horizon? Any challenges they pointed out?
There were a couple, yes. Ongoing geopolitical tensions, messing with supply chains globally, that's always a risk. Sure. And more specific to banking, the falling interest rate environment could potentially squeeze those net interest margins and NIMs. That's something all banks were watching closely.
Right, the core profitability. Okay, so with that context, let's dive into Bank of Maharashtra's actual numbers. How do they look, say, year over year for Q1?
Pretty impressive, honestly. Total business that's deposits plus advances grew by over 14%, hitting about 546,000 crore.
Okay, strong growth there.
Deposits were also up around 14%, reaching over 305,000 crore. And gross advances, their loans, grew even faster, up over 15% to roughly 241,000 crore.
So good momentum across the board, deposits, loans, overall business. How did that translate to the bottom line?
Very well. Net profit jumped significantly, up by over 23% year on year to 1,593 crore.
Wow, 23% profit growth.
Yeah. Operating profit was also up by 12%, and net interest income, the NII, that core earning metric, grew by a healthy 17.6% to nearly 3,300 crore.
Okay, strong profit numbers. But for banks, asset quality is always the other side of the coin, isn't it? How did they do there?
This is where they really shone, I think. Their gross non-performing assets, or NPAs, bad loans, essentially actually decreased.
Decreased, even with loan growth.
Yes. It fell to 1.74% from 1.85% the previous year. And net NPA after provisions improved even more, down to just 0.18%.
0.18% net NPA, that's incredibly low.
It really is. And their provision coverage ratio, the buffer against those NPAs, was super strong at 98.36%.
Almost fully provided for.
Yeah, exactly. And other key ratios looked good too. Return on assets, ROA, improved to 1.80%. And this is interesting, their cost-to-income ratio actually improved slightly to 37.57%.
Improved. Usually with growth, costs go up. How do they manage that? That seems very efficient.
Yeah. Management highlighted that CI ratio as one of the best in the industry. We can dig into how they manage that efficiency later, but it's definitely a standout point.
Okay, let's circle back to that NI and the net interest margin. You said falling rates were a potential pressure point.
Right.
But their NI was 3.95% for the quarter. And I remember seeing their own guidance for the year was more like 3.75%. So they outperformed their own sort of conservative estimate.
They did. And this is where it gets really interesting, especially since, as you noted, 40% of their loan book is directly linked to the repo rate, which the RBI was cutting.
So how on earth did they protect that margin? What was the strategy?
It seems like a really deliberate multi-part strategy. First, on the funding side, they consciously avoided chasing expensive, high-cost bulk deposits. They said they hadn't really gone for those for the past 10, 12 months.
Okay, avoiding pricey money. Makes sense.
Second, they kept their CASA ratio current account savings account very high, with just over 50% this quarter. That's cheap, stable funding. And importantly, their case of deposits actually grew by 14% year on year.
So strong, low-cost deposit base, that's one side. What about the loans?
That's the other key part. About 55% of their loan book is linked to their MCLR, the marginal cost of funds-based lending rate. It's their internal benchmark.
Right.
And over the previous 12 months, those MCLR-linked loans had actually seen rate hikes averaging around 35 basis points. And crucially, the impact of those earlier hikes was still filtering through. Some loans were still resetting to those higher rates in Q1 and maybe even Q2. So while new repo-linked loans felt the rate cuts, a big chunk of their existing book was actually earning more.
So it was like a built-in cushion from past rate hikes on the MCLR side, offsetting the repo cuts on the other side.
Exactly. It's a really smart piece of liability and asset management. Very proactive, not just reacting to the RBI. That really protected the NI.
That is clever. Okay, back to efficiency. The cost-to-income ratio improved to 37.57%. How? Was it just cutting costs everywhere?
Not necessarily just cutting. Their management stressed this idea of growth with profitability. They seem quite disciplined, meaning they scrutinize new business very carefully. If a potential loan or transaction doesn't meet their profitability benchmarks, they're apparently willing to just say no, even if it means less top-line growth.
Quality over just quantity.
Precisely. They also mentioned implementing software tools to help branches track their own profitability, trying to build that cost awareness culture from the ground up.
And non-interest income, did that help?
It was a bit mixed. Overall, non-interest income dipped slightly by about 8% year on year. But within that, the fee-based income, things like processing fees, commissions that actually grew by a solid 8.5%.
Okay, so they're focusing on generating fees from services. Got it. Let's shift to the loan book itself. Advances grew over 15%. What was driving that?
A lot of it was the RAM segment, that's retail, agriculture, and MSME. That segment now makes up over 62% of their total loans.
Right.
Retail was the real star performer, growing over 35% year on year.
35%. What within retail?
Gold loans were a huge part of that, up an incredible 58%, but other retail segments likely contributed too. MSME loans grew moderately at 5.6%, and agri loans at about 2.9%.
Okay, strong retail push, especially gold. And despite that rapid growth, you said asset quality held up extremely well. Low NPAs, high PCR.
Exactly. Gross NPA at 1.74%, net NPA at 0.18%, and that 98.36% provision coverage ratio. Very strong metrics.
But there were some new slippages, right? Loans turning bad in the quarter, about 727 crore.
Yes, that was the figure for fresh slippages in Q1.
And I think you mentioned almost half of that, around 343 crore, came from agriculture. Should we be worried about that?
Well, the management addressed this directly. They said Q1 often sees higher slippages in the agri sector. It's somewhat cyclical.
Okay, a seasonal thing.
Kind of, yeah. But more importantly, they stated they had already upgraded 240 crore out of those fresh Q1 slippages by the time of the earnings call, meaning those loans were already performing again.
So quick recoveries too.
Yes, and they also pointed to forecasts for a good monsoon season as a positive factor for the agri portfolio going forward.
Right, good rains help farmers, helps loan repayments.
Okay.
Now, you mentioned their MSME asset quality is consistently better than many peers. What's the secret there? Did they share anything?
They did give some insights. It sounds like a combination of factors. One is tougher underwriting standards generally. They gave an example. No retail loans for anyone with a credit score below 681.
That's a pretty high floor.
It is. For MSMEs specifically, they talked about focusing on quick decision-making. Apparently, they believe businesses value that speed and are willing to pay a slight premium for it, maybe 25 basis points more.
Interesting. Speed as a differentiator.
Yeah. And they're not just lending to any MSME. They use targeted cluster schemes and have specific credit rating thresholds to focus on what they call the right segment borrowers.
So more targeted lending.
Exactly. The goal, they said, is to build a prime borrower loan book. The idea is that if there's an economic downturn, a prime book won't be hit as hard as one with lower quality borrowers. It's risk management, basically.
Very deliberate strategy. Okay, now this gold loan thing and the MSME reclassification that sounded a bit confusing. Can you walk us through that?
Right, it's like a bit technical, but important. So the RBI issued guidelines that changed how certain gold loans were classified. Loans up to 2 lakh, which might have previously been counted under agriculture or MSME for priority sector lending targets.
Wait, priority sector lending, PSL, those are the mandatory lending targets banks have for specific sectors, right?
Exactly. So these gold loans suddenly got reclassified as just retail, not counting towards the agri or MSME PSL targets anymore. That could have made it harder for the bank to meet its quotas.
Okay, I see the problem.
But then, literally 2 days before their earnings call, the RBI issued a clarification.
Ah, what did it say?
It said essentially that these gold loans can still count towards PSL if the borrower voluntarily declares the loan is being used for agriculture or MSME purposes.
So they can be reclassified back.
Potentially, yes.
Oh,
For Bank of Maharashtra, this affected a sizable chunk, about 30,500 crore in their co-lending gold loan book that has shifted to non-priority retail. Now, much of that could potentially move back to count towards PSL.
wow, that's quite a turnaround. Shows how quickly regulations can impact things.
Absolutely. It really highlights the dynamic environment these banks operate in.
Okay, moving on to funding. We know deposits grew strongly, over 14%, and that CASA share is high at over 50%. Seems like a solid funding base.
Very solid, stable, low-cost funding thanks to that high CASA ratio.
And what about capital? Are they well capitalized for future growth?
Extremely well capitalized. Their capital adequacy ratio, CRAR, stood at 20.06%. Tier 1 capital was 16.63%.
20%. That's way above the regulatory minimums, isn't it?
Way above. Think of it like a financial safety cushion.
Hmm.
Theirs is very thick. Management's own guidance is just to maintain it around 18%, so they have plenty of headroom.
So no need to raise capital soon then?
They explicitly said there's no immediate need. They do have board approval to raise up to 7,500 crore through a mix of debt and equity if they want to, maybe if a great opportunity comes up, but they're not under any pressure.
Gives them flexibility. Okay, let's look beyond the numbers. What about their strategic initiatives? You mentioned expansion plans.
Yes, this is quite ambitious. They have a board-approved plan to open 1,000 new branches over the next 5 years.
1,000 branches, that's a massive expansion.
It is. And, more immediately, they have something called Project 321, aiming to open 321 branches in the next 18 months. They've identified specific high-potential growth areas across the country.
Wow. They must be hiring quite a bit to support that.
They are, and they mentioned specifically recruiting for specialized skills, compliance, risk, IT showing their building capability alongside the physical expansion.
Makes sense. What about the digital side, technology?
They're working on that too. A revamped mobile banking app is coming soon, aiming for a world-class experience, they said. That should launch in about a month or so from the time of the call.
Okay, improving the app. Anything else?
Yes, something potentially quite significant. They got approval, apparently very quickly, in under 5 months for a Gift City International Banking Unit, an IBU.
An IBU in Gift City. What does that let them do?
It lets them participate in global finance more easily, things like international loan syndications, arranging external commercial borrowings, ECBs, for their corporate clients. They expect to start booking business through the IBU in Q2. They call it a potential game changer.
Interesting. Expanding their reach internationally then, and their current digital uses.
Already very high. They reported that almost 99% of their transactions are digital.
Impressive adoption. Okay, beyond finance and tech, did they mention ESG, environmental, social governance initiatives?
They did. They have a Maha Green Pihal initiative focusing on climate risk data. They're actively trying to reduce plastic and paper use. And they highlighted their green finance portfolio loans for greenhousing, electric vehicles, solar, renewables, totaling over 4,000 crore, plus efforts in e-waste collection and a significant tree plantation drive over 12,500 trees planted.
So definitely incorporating ESG into their operations. And just quickly, anything on their workforce or recent recognition?
Yeah, workforce is over 15,400 people. Interestingly, 70% are under 40 years old. Quite a young workforce for a public sector bank.
That is young.
And they invested heavily in training over 262,000 man-hours just in Q1. Recognition-wise, they picked up several awards, including India's leading mid-sized public sector bank from Dun & Bradstreet and some IBA technology awards.
Okay, so getting recognized for their performance and tech efforts. All right, let's try and wrap this up. What's the big takeaway for you, the informed listener, from this Q1 performance?
I think it paints a picture of really consistent, profitable growth. It's not just growth for growth's sake. It seems very strategically managed.
Right, that focus on profitability, the NIMR protection, the prime loan book strategy.
Exactly. They seem to be proactively shaping their path. Not just being carried along by the economy. They're making deliberate choices about where and how to grow, focusing on asset quality, efficiency, and leveraging technology.
It's a fascinating mix of traditional banking strengths, like that strong CASA base, with this push into new geographies and digital capabilities like the IBU.
Definitely. And as you reflect on all this, maybe consider this. We're in this era of intense digital change. Customer expectations are shifting fast.
Yeah.
How much further can a bank like this, with deep roots, push the boundaries of innovation while still playing to its strengths?
That's a great question. It makes you wonder what innovations will really set banks apart in the next few years. Is it just about the tech, or is it something deeper about how they connect with customers and manage risk in this new landscape? Something beyond just the balance sheet numbers.
Precisely. What will capture the loyalty and business of that next generation while keeping the ship steady? That's the ongoing challenge and opportunity.